What makes a company withhold dividends? Is it forced by financial strain or driven by strategic ambition? For Citicore Renewable Energy Corporation in 2025, the evidence points to the latter, a business channeling capital into growth rather than denying shareholders their due. This distinction is vital. In the Philippine market, investors tolerate minimal payouts only if a credible expansion story justifies it. CREC's numbers tell that story. By year-end, 14 solar assets and nearly 600 megawatts of installed capacity, supported by a pipeline of almost 3,000 megawatts more in solar and wind, plus over 1,000 megawatts newly secured from government auctions. This is not a finished utility. This is an enterprise still accelerating. The financial statements confirm that momentum. Assets soared to 81 billion pesos, almost doubling from the previous year. Investment in property, plant, and equipment rose similarly. Concrete evidence of capital transforming into infrastructure rather than accumulating for distribution. Companies actively building rarely become dividend machines. Cash reserves climbed to 18 billion pesos, but that isn't idle wealth. Management attributes the surge to project loans and fresh equity, including a major stake from Pertamina NRE. These funds are earmarked for construction, not dispersal. A company raising capital to build should not be expected to hand it back to shareholders prematurely. Perhaps most telling, CREC's entire under-construction portfolio is backed by offtake contracts. In renewables, adding capacity against contracted demand is measured growth, not speculative risk. Diversified sales through government programs, bilateral contracts, and retail agreements reinforce the value of reinvestment. Still, the earnings profile is modest despite dramatic asset gains. Revenue and net income are up, 3% and 14% respectively, but returns on assets and equity remain subdued. Investors are asked to trade immediate cash for the promise of future scale, a rational but trust-dependent bargain. Leverage is rising, with debt outpacing equity. Yet renewables are capital-hungry, and the company pairs this debt with strategic equity and a vertically integrated execution model, shortening timelines and reducing friction, a crucial trait for compounding retained capital. For now, CREC's operational discipline argues for patience. Fast development cycles, reliable execution, and centralized control all support retaining earnings to fuel growth. Cash trapped by a slow builder is wasted. Cash managed by a credible engine is likely to multiply. Dividend absence in 2024 and 2025, despite policy, reflects flexibility as the development pipeline is built, not a lapse in discipline. This reinvestment thesis is not a permanent exemption. Shareholders will expect eventual returns. CREC's foundations are strong, with expanding capacity, surging assets, committed capital, and a contracted pipeline. The next milestone will be commissioning assets, boosting earnings, and translating growth into tangible returns. At this moment, the numbers speak clearly. CREC is not hoarding cash for lack of vision. It is spending deliberately, with the answer for shareholders waiting just ahead, in new plants, new power, and a future where reinvestment pays off.